You clicked on this video because you have already maxed out your other accounts and you are staring at a confusing choice between Roth and traditional 401k options. You are a high-income earner who has likely heard that the Roth route is always the safer bet for the future. The real problem is that this default assumption might be causing you to overpay taxes significantly over your lifetime. By the end of this video, you will understand the specific tax arbitrage fallacy that traps smart savers and learn how to reverse engineer your optimal contribution mix based on future marginal rates rather than current ones. Let us start by addressing the prevailing belief that many of you hold. There is a common narrative that suggests defaulting to Roth 401k contributions guarantees superior returns because you pay taxes now at a known rate and avoid taxes later. This logic feels sound on the surface. It seems like a way to lock in a lower tax rate before the government raises rates in the future. However, for high-income earners who have already exhausted their backdoor Roth IRA and HSA contributions, this strategy often leads to a suboptimal outcome. The flaw lies in assuming that your future marginal tax rate will mirror your current one, or that it will inevitably be lower. When you are in a high tax bracket, every dollar you contribute to a Roth account is a dollar that is permanently removed from your taxable income at your current high rate. You are paying the highest possible tax on that specific dollar right now. Consider the concept of the marginal dollar. For someone earning over $135,000, the last dollar you earn is taxed at your top marginal rate. If you choose to put that dollar into a Roth 401k, you are effectively paying that top rate immediately. You lose the ability to use that money to lower your current taxable income. In contrast, a traditional 401k contribution creates an immediate tax deduction. This deduction reduces your taxable income for the current year, potentially dropping you into a lower bracket or simply saving you money on taxes you would otherwise owe. The value of this deduction is often higher than the theoretical benefit of tax-free growth later, especially when you consider the compounding effect of having more capital to invest elsewhere. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. Here is the thing that most calculators fail to account for. Generic tools like the Smart 401k Calculator or the 401k Acton or the 401k often treat all contributions as a single aggregate balance. They do not differentiate between the tax treatment of the last dollar earned versus the first dollar saved. These tools assume that tax rates will remain static or that the future will be simpler than it actually is. For high earners, the reality is far more complex. You are not just dealing with a binary choice between two tax treatments, you are dealing with a production trade-off where prioritizing pre-tax contributions first maximizes your immediate tax deferral. This creates a larger tax bucket that can be managed later through strategies like the mega backdoor Roth. The optimal mix is not a binary decision, it is a function of tax bracket stacking. This means that traditional contributions should be prioritized only up to the point where they push your total taxable income into the next tax bracket. Once you hit that threshold, any remaining available savings should be routed to Roth or taxable accounts. This approach is known as marginal rate matching. You calculate the exact dollar amount of traditional contributions that keeps your total taxable income at your current top bracket threshold. By doing this, you are not guessing about the future. You are optimizing for the present while preserving flexibility for later. Now consider the failure mode of defaulting to Roth 401ks for high earners. When you prepay taxes at a high rate, you eliminate your ability to use traditional 401ks withdrawals as a tax bucket to fill up lower tax brackets in retirement. This is a critical loss of tax diversification. In retirement, you will likely have other sources of income, such as Social Security, pensions, or withdrawals from taxable accounts. If you have exhausted your traditional 401k balance by converting everything to Roth early on, you lose the ability to manage your taxable income in retirement. You might find yourself forced to withdraw from Roth accounts when your other income sources are low, paying a higher effective tax rate than necessary. There is also the compounding issue of required minimum distributions. For high earners, the compounding RMDs on a large traditional balance in later years often force a higher marginal tax rate in retirement than the current rate. This dynamic invalidates the Roth default strategy for many people. If you have a massive traditional balance, the RMDs in your 70s and 80s could push you into a higher bracket than you are in now. However, this is a problem you can solve by not filling your traditional account to the brim in the first place. By reverse engineering the optimal mix, you can avoid the RMD trap entirely. You can plan your contributions so that your traditional balance grows to a level that provides income without triggering excessive RMDs. The practical implementation involves a specific algorithm. You must model the tax drag of required minimum distributions on your traditional balance. For high earners, this means calculating the exact dollar amount of traditional contributions that keeps your total taxable income at the current top bracket threshold. You then route all remaining available savings to Roth or taxable accounts. This strategy allows you to bypass income limits and optimize for future tax rates rather than current ones. It is a more nuanced approach than simply following a blanket rule. It requires you to project your future marginal rates and understand how your income sources will interact in retirement. This approach requires a shift in how you view your savings. Instead of seeing your 401k as a single account with a single tax treatment, you should view it as a portfolio of tax buckets. Each dollar has a different tax cost depending on when you contribute it and when you withdraw it. By prioritizing pre-tax contributions up to your bracket limit, you are essentially buying a tax deduction at the highest possible value. You are using the government's tax code to lower your current tax bill, which gives you more money to invest in other vehicles. This creates a larger tax bucket to be converted later via mega backdoor Roth strategies. This reverse engineering approach allows high earners to bypass income limits and optimize for future tax rates. The key insight you need to carry forward is that the tax arbitrage fallacy assumes future marginal rates will mirror current ones. This is rarely true for high-income earners. The smartest move is to treat your current top bracket as a ceiling for your traditional contributions. Anything beyond that ceiling should go to Roth or taxable accounts. This ensures that you are paying taxes at the most efficient rate possible. You are not overpaying on the marginal dollar. You are using the tax code to your advantage by creating a flexible portfolio that can adapt to changing tax laws and your personal income trajectory. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.